When I talk to C-level executives, to startups, to anyone in the field of AI, they all mention speed, which is the biggest fear.
Our Middle Eastern investors are like at the intersection of like tradition and innovation. They are still very keen on innovating. They're very quick to adopt and adapt to new technology.
2015 around March, the whole of the GCC woke up by an announcement that Talabat was sold for $150 million.
Because AI is about non-linearity between hundreds of variables. So good luck explaining that. But you still need to be able to show of why the engine is going that way and not that way.
I believe to start with digital assets, because to the majority of people, it's still an unknown. And everybody thinks stable coins and crypto are all the same thing, but they're actually very different.
Ladies, gentlemen, excellencies, thank you for coming to tonight's discussion. My name is Denis Grabchak. I'm a founder of an AI analytics company in Silicon Valley. And what my company does is that we help C-level executives in Silicon Valley make better decisions with AI. And in the UAE, I'm on a mission to build the UAE's first applied AI accelerator for startups to bring talent here. And I've only been asked to do this yesterday, and I'm really excited. But when I got asked to do this and think about this, the first sort of idea that came to mind is, when I talk to C-level executives, to startups, to anyone in the field of AI, they all mention speed, which is the biggest fear. It's happening really fast, and the fear of missing out is really great. But what I really like is that speed is not uncommon for the UAE. In 1971, this country was relying on traditional industries, and very quickly, based on a chain of bold decisions, strong leadership and vision, the country became one of the key hubs for innovation. So tonight we're going to talk about private family offices. We're going to talk about private equity. We're going to talk about investment and how AI is affecting that. And to start off, I'll ask each panelist to introduce themselves for 2-3 minutes with, first of all, the experience, but also what are they passionate about right now, looking forward into the future.
Hello there. So I'll start. And firstly, I'd like to say it's a great pleasure to be here in Dubai today. Great city, great venue, great people. A lot of smiling faces here, and there's certainly a big positive vibe coming here in Dubai. And yesterday in Sharjah was just exceptional as well. I'd like to say the venue in Sharjah was mind-blowing. So it's absolutely great. I'm Xavier Marconnet. I come from Switzerland. I work for Unigestion. It's a 50-year-old asset management firm. And we manage equity solutions for large asset owners, which a lot of AI now is part of the alpha engine, if you like. And beside this job, I'm also a professor at the Geneva Business School, where I teach bachelor and master students investment management. In terms of what makes me tick today, well, actually, giving back to my students, if I may say. I think for me it's very important, as we get older, more experience, to share with the next generation. For me, it's very important. So I would say actually my part-time job is really what makes me tick. But also meeting people. We are very fortunate to work in this industry. We get to travel, get to meet amazing people, work on innovation. So this is, that's it for me. Thank you.
Hello. Thank you very much, everyone, for coming, and it's a pleasure having you here. I am Mohammed Al Othman. I'm the CEO of AI Tech Solutions. In AI Tech Solutions, we build consumer-focused AI products from search engines up to robotics. And we started this company 1 year ago And as Dennis said, in terms of AI, everything is fast. 1 year in AI is like saying 5, 6 years in a normal industry. Previously, I was the CEO of Fujairah Holding, a semi-government fund in private equity. We do private equity mostly, but we build as well and we operate. Yeah, that's it. Thank you very much.
Hello, everyone. My name is Shabnam Mohammed. I am currently the CEO of Black Mountain Consulting, also previously independent board member at Dubai Islamic Bank, Pakistan, and I'm a nominee director for the IFC World Bank for any of their investee companies within the region. My background is more from investment banking and private equity. I spent 27 years in between the two industries. The first 20 years in investment banking, working for Deutsche Bank on the more of the emerging markets structuring of capital market products and structured products. And then for the last 7 years, I was a CEO at Tel Group, which is a private equity firm, where I was head of special situations, where we managed essentially underappreciated asset classes or underpenetrated geographies in terms of specific strategized funds for those. Within Black Mountain Consulting, I spend a lot of my time focusing on single-family offices, essentially, that have not yet managed to put governance around their structures, figured out their investment strategies, and figuring out the next steps for the future, but also succession planning and portfolio management. So as a function of that, of course, this is a very important conference to be at, to have the discussions about how things are progressing in the future. And today's discussion around AI and, of course, technology impacting all of these industries that I've been a part of, whether it's private equity, whether it's family offices, and even investment banking. But at the same time, what's close to my heart in all of this is that as we work towards making the wealthy wealthier, we continue to also think more about financial inclusion, and whether with all of these alternative sort of, artificial intelligence technologies, everything is advancing massively. We want, obviously, our clients to benefit from that, but what we want to try to be cognizant of is the fact that we are not widening that gap inadvertently between, obviously, all of our ultra-high net worth individuals and the rest of society, and particularly the ones who are in greater need. So that's more my passion, which I would say financial inclusion and general equity around the world. Thank you.
Hi, my name is Suraj Reddy. I'm co-founder, CEO of Voyage Capital. Just some background on me. I'm not from a finance background, no fintech background. I don't have a financial degree. I'm a practicing physician in the US, and I have the honor of attending to some very high net worth athletes. It's kind of nice to see how some of them generate and preserve wealth, and some of them don't do as good of a job. My background is, my family has been in real estate for about 50 years, but more from the retail side. So I come from a different background in that I've assessed different asset classes in coming from a retail side. And now with my partner, I run a mid-sized fund. We have about 200 million assets under management. And we have retail investors, family offices, and we're looking to grow into hopefully $1 billion company soon, and hopefully by growing globally. So that's the plan.
Thank you for the introductions. And as you can see, the panel is very diverse and very insightful about the topic. And the first question is, obviously being in the UAE and being in the Middle East, what are the unique cultural and regulatory considerations that family offices face in the UAE, being in the Middle East? And I would like to address that question to Shabnam.
Thank you, Dennis. I think with the cultural dynamics, it's quite evident, Middle Eastern families are very much focused on generational wealth. They're also extremely extremely focused on confidentiality and being discreet with things. So decision making will often involve private advisors. Also, another one of the important things is, of course, with regards to the family structures, you'll always often have someone senior that has a big say in how decisions are made and investment processes. Sharia compliance is a big factor for a lot of our investors, so that's a cultural factor that comes into play. Avoiding, of course, interest-based, lending and so on. And so essentially, those are factors that we have to take into account when we're considering how to handle our regional customers and the dynamics of their culture. But at the same time, having said that, there's, our Middle Eastern investors are like at the intersection of like tradition and innovation. They are still very keen on innovating. They're very quick to adopt and adapt to new technologies, not all the time, but overall, for sure, on the government level, we can see that. So there's that, and then of course you have the regulatory landscape and how that works. Now within the UAE, what we can talk about is the fact that we have specific structures in place in the DIFC and ADGM with regards to trust structures and other sort of facilitating frameworks, let's say, that will enable family offices to set things up in a way that gives them the required governance. Where we still need to see some work is in the cross-border transactions within the GCC itself. So from one country to another, there's still some space for improvement in that respect. But those are the key things that I would say, are the things that we need to look at.
And from your experience, are you seeing a growing interest in alternative investments like venture capital, private equity, and digital-based assets?
Yeah, most certainly, definitely we are. For multiple reasons, of course, diversifying away from oil investments. Previously, of course, historically, what we have seen is within the Middle East, so family offices are heavily invested in real estate and some oil-based, oil businesses and so on, which they're trying to diversify away from. But for sure, especially with the new generation coming up and becoming more participative in the investment of sovereign wealth funds, what you are seeing is a greater interest in slightly taking greater risk and going for alternative asset classes such as PE, VC, and of course, tech startups. And other reasons for that are the initiatives, for example, that the government's been taking. Dubai, the UAE in general, is becoming a tech hub, or trying to. They're trying to attract not just fintech, but health tech and ed tech and whatever kind of tech there is out there today. They're trying their best to create a conducive environment for people to come and invest here and for startups to do well here. So overall, I would say that the environment is improving generally. The deal flow is getting to a point where people are seeing more potentials for investment, and therefore, as a result of that, for sure, family offices are participating more in the alternative asset classes. But another thing that's interesting is they're also sort of following suit from the sovereign wealth funds. So if a sovereign wealth fund is, and they are making some bold moves going into tech and going into other kind of private equity and VC, and the family offices will take comfort from that. And because they take comfort from the fact that, of course, the sovereign wealth funds will have done their masses of due diligence, and of course the fact that they have huge amounts of insight. So we're for sure seeing a huge growth in that area. We're probably still quite behind if you look at it compared to, like if you look at UBS's report for family offices and how most portfolios are structured nowadays. It's actually become like a 60-40 split between alternatives and your traditional asset classes. I don't think we're there yet in the Middle East, but we are for sure going in that direction.
Thank you so much for the answer. And maybe, Mohammed, leaning on your experience as the CEO for Fujairah Holding, what sort of other trends and maybe emerging trends you saw in your position?
Let me just go back in history and explain the landscape or what happened in venture capital in the GCC. 2015 March, around March, the whole of the GCC woke up by an announcement that Talabat was sold for $150 million. At that time, I was raising capital for my second startup. Before that, $100,000 was looked at as you are mad to invest in a startup. Today, in this region, people are raising more than $1 billion, $10 billion, whether it's sovereign wealth funds or family offices. So the appetite for family offices came out. Family offices, especially in this region, they like wealth. They like things to grow. And at that time, they only had real estate. If you speak to my elders, they will say to you, and you say to them a startup, they will say to you, yeah, but look at Mecca, 1,400 years ago, and the real estate is still there. So it was difficult, but Talabat changed everything. $150 million from $600,000, people started to look into it more and more. In Fujairah Holding, our board member was very aggressive. I was entering into West Africa by a business plan only, not even something that is up. And if I want to say to you West Africa, no one in the GCC could have succeeded in West Africa. Zain tried to go there and came out with heavy losses. So yes, I see that there is a huge demand and appetite to VC and private equity in this area.
That's very interesting, and I'll definitely remember what you said at the beginning, that AI is like dog years. It's not just like 1 year for 1 year, it's like 1 year for 7 years at least. And the next question I have for you, Xavier, it's very interesting to hear your perspective on how is AI transforming quant and cutting-edge technologies, because there's a lot of sort of news about that, but where does the line lie between sort of hype and reality?
Okay, thanks. It's a good question, actually. Hype was a question from the first panel about the substance of AI. In crypto AI, it was at the time. So in terms of landscape, we can think of maybe different angles. First, from the asset owners / consultants, there's this kind of, they love to put people in boxes, categories. So today, there's a big debate about are you traditional quant, are you AI quant? And I think it's a bit of a lost time. I think there's more a case of a 50 shades of gray, if I may say, that you don't have to be one or the other. And I think we're in the middle of the spectrum. It's not because you embrace AI technology in your investment strategies that you're going to go and compete with Three Sigma Capital all of a sudden. We are still an asset manager that has a lot of institutional clients who are sensitive to turnover, for example, who will look for outperformance over like a business cycle. So we're not into the game of high frequency trading just because we go into AI. So again, you have to teach people that it's not kind of 0 or 1. It doesn't have to be binary. And also something, we talk about speed a lot in AI, it's true, but I think AI is also a tool for customization. I think what's changing a lot today is that we can really customize solutions for our clients. An example I'll give you is that we have a large insurance company in Germany with a fairly high dividend yield constraints. So for them, distribution of dividend is paramount. Capital gains, don't get me wrong, very good over the long term, but payments of dividend is paramount. So there's a fairly high threshold of the dividend yield we need to get. But this is a minimum. It doesn't mean it's optimal. So one of the first applications of AI we did actually was to try to find, okay, if 3.5% yield is your minimum, what is your optimum? And sometimes you may want to be a bit higher, So if through the AI prediction we see that dividend yield is going to be a good feature and you want to be overweight dividend yield, then we'll go a bit more than 3.5. When the machine's outcome says, actually, you know what, I think value/dividend is going to be a bit of a tough time, then we'll go back to 3.5%. So AI is very much here to enable you to customize for your clients a lot more than before, I would say. After that, you know, there's a lot of course, in terms of how you set up your team, that's changed, you know, because data is key. You know, in order to succeed in AI and investment management, you need data. You need the algorithms. So you need like smart PhDs to really work on these signals. You need computing power, you know, of course, and speed is still important. You want to crunch these large data sets fairly quickly. But the human capital is super important as well. So is it hype? Is there some substance on it? It's very important for us to also show it to our prospects and clients. I think we suffer maybe from a bit of a ESG greenwashing we had a few years ago, whereby a lot of funds sold themselves as ESG. And actually, they were just doing the bare minimum, and I think they got caught up. And today, there's maybe a risk, indeed, that there's a lot of AI bashing, that just because people maybe use a prompt through ChatGPT to get some sentiment score on any stock, all of a sudden they sell themselves as AI. So this is completely wrong, obviously. So it's our duty, I think, for the managers in the field to be very transparent about the models we use. How important are they in the process? So for us, the alpha signal is purely coming from AI models. It's, it's very clear. But also show them, open the bonnet of the car. Show them the engine. Why does AI like a stock today? What are the features driving why, a stock like, I don't know, MasterCard, whatever, is liked by the model today? You need to be able to explain your model, and this is tough. Because AI is about non-linearity between hundreds of variables. So good luck explaining that. But you still need to be able to show of why the engine is going that way and not that way. So these are the challenges into the changing landscape. But there's a lot of opportunities. But also, yes, indeed, fight your corner and show that there is a lot of substance into what you do in AI.
Thank you. And I have a question about tokenization of real-world assets to you, Dr. Siraj, because your experience is very interesting, being a physician, not having a degree in finance, but managing assets and doing investments. How do you think is going to transform the traditional sort of forms of investing and the mentality of investors as well?
Yeah, so I personally think real estate is a great way to create and preserve generational wealth. And like you had mentioned, it's a hard asset, and everybody always believes that it holds a value at all time. And we're always, personally, family offices, everybody's looking for ways to diversify and spread risk around by taking real estate into digital assets. You're able to prevent it from being a regional play now to something that's global, which helps diversify and de-risk. So real estate in one country might be booming at one time, but it might not last forever. But right now, the way traditional US funds and what we've done in the past has been a US fund has US investors that invest in US real estate. And as long as that's doing great, then that works out. But when there's a dip in that economy, it's tough on all the people in that class. But once you are able to make it into a digital asset and go global, you're able to have US investors in other countries and have other countries invest in the US. So I think it's a great way for everybody to be able to be risk averse a little.
And have you seen any other assets being digitized, sort of apart from real estate?
I think because real estate is something that you can easily evaluate and you can find data on it, it's a good place to start. So we work in hotels itself, in the hospitality sector, and it's a booming industry, but everything Expedia, Travelpedia, there's Star Reports, there's a lot of data out there. So that's a good place to, I believe, to start with digital assets, because to the majority of people, it's still an unknown. And everybody thinks stable coins and crypto are all the same thing, but they're actually very different, and they come from different types of classes. So I think that if you start in a place that everybody aspires to own and has data, then that's kind of proof of concept. And then once you see that that works by digitalizing and having fractional ownership, then at that point you can put that to anything out there. But when you take an unknown and you put it into another unknown, it makes it very difficult for people to invest in. But if you at least take a little unknown and you put it into something that is known and easily researchable, that helps people get comfort with it.
It's very interesting. And I want to ask the audience, please do prepare your questions, because after a few more questions, we will come to you for your opinions and comments and questions. My next question is, Shubnam, in terms of your experience in private equity, how is private equity leveraging AI to streamline processes, but also to find better deals with higher returns?
So with private equity, pretty much throughout the entire life cycle of the deals, AI can be used quite extensively, and it is being increasingly used. So, for example, for deal sourcing, AI is being used now because you basically have these huge data sets that you can now go through, where you're not only looking at your typical private equity deals and looking through and going through your due diligence and valuation process by using AI, and of course also machine learning, but then you also have access to additional transactions that you wouldn't normally have access to, because you wouldn't have the required analysis data and the required background information to be able to actually even know that those deals exist in some instances. So with AI, of course, they're doing the traditional valuations, but they're also then able to look at things like, especially for when you're talking about VC, for example, with startups, they for sure will be looking at things like sentiments. They'll be looking at, founder boards and other things for additional information that when it comes to investing. But for PE, for sure, because what you have now is, because of these huge data sets, and the ability to analyze them at super fast speeds, you are able to go through a much larger amount of deal flow, which means you can actually select better quality deals from it, but also obviously the fact that you're going through so much more than you would with a manual process, with an intuition-based investing. That's an essential thing in basically fast-tracking the amount of transactions you go through, and then you can pick from them. And then once you've actually gone through the investment process and you've acquired a company, of course, AI is used to optimize processes, to try to make the company more efficient, to improve cost ratios, et cetera, et cetera. So overall, to improve the performance and optimize those companies before you go to exit. And then again, within the exit strategies with AI, what you have is a much better analysis of deciding on when to exit, timing, identifying all of these different features that would normally be done on an intuition basis, based on market knowledge, because of course private equity transactions are, it's not all publicly available information. So when you're thinking about exiting, you can actually assess so many more parameters than you would normally be able to do with a manual team. And then as a result of that, you will have much more nimble teams. You will have much more, less people in your teams, which is not always a great thing, of course, on an overall basis. But ultimately, you can focus on things that are actually more value-adding. There will be benefits to your investors. There will be benefits to your teams. There will be benefits to the performance of your fund, which ultimately obviously benefits the GPs as well.
Great, great. I want to lean, Mohammed, on your experience as an investor, but then what you do right now in terms of helping companies launch AI. And obviously, the whole AI sort of starting point is data. And I want to ask you, how do you think big data and AI can help unlock sort of unconventional investment opportunities? And at what stage can you start trusting the data that you're not basically having blindfolds in terms of like the cleanliness of data and so on, propagation?
The first part of AI that I want to talk about that many don't have a huge idea about it. You're talking about large language models mostly when we use big data now for it and generate the answers. These are things like ChatGPT. However, the problem is if you use them for alternative investments and depend on them 100%, there is a huge problem because they hallucinate. They have a certain point that they learned and then they stopped. So here you have to interfere, bring more techniques in prompting, RAG, LangChain, and so on. So this is one thing. It's about dependence. Many people, they say, okay, now we have large language models, all asset managers outside. I don't think so, not even in the near future. How can it help? It's exactly what Shabnan said. It can go into read large amount of data, see what's history, see what's my sentiment on this product or in that product, things that I couldn't do before, or I wasn't able to do it before without using large language models. I cannot go over 1,000 documents in a term of 3 or 4 days, but large language models can do it within 1-2 minutes. So it improves efficiency. And I think this will soon improve in their margins and their bottom lines.
That's a great answer. And continuing on the topic of sort of how much AI becomes autonomous and how much you still have to look after it as a human, Xavier, maybe you will be a doctor at some point.
Not doctor yet.
Not yet, yes. The question is, in the age of automation and AI, how much is human oversight, like, is it still important, and to what extent, like, we can basically step back from it, like, with time?
Yes, well, it's clearly undeniable that these machine learning models can process volumes of data that the human brain will not be able to do so quickly. But the relationship between mind and machine is quite interesting, actually, I find, because on the one hand, you need the machine, especially to correct or mitigate cognitive biases by the human. I give an example that I don't know if you know, like equity investment, but the value factor. Investing into undervalued stocks. These are stocks with little growth prospects, but they pay nice dividends because whatever money they make, they give it back to the shareholders. It serves a purpose, right? Income investors need value stocks, but they've underperformed massively. So what does the human try to do when something has worked less well? Try to fix it. And so a few years ago, there was a lot of papers published about how if you magically add intangibles into value, value works. If you run backtests, all of a sudden you have a value factor that works better. But we did that, we looked, all you do is you add tech into value. Of course it's gonna work. It's not what value is about. So again, the human gets it completely wrong, try to fix something that worked in the past with absolutely no guarantee that it's gonna work better in the future. So AI for us helps us actually to better define these equity risk premia. For example, if you look at quality, quality is about investing into profitable companies with stable earnings and okay leverage, let's say. Some people would say, okay, well, let's just use 1/3, 1/3, 1/3. But again, it's not optimal. What you can do is through AI, actually let AI define which of these submetrics are the most important and attractive today. So actually, your definition of what quality as a factor should be varies through time, and AI keeps learning continuously. So it's not the portfolio manager that says, whoa, our quality factor has underperformed someone else's quality factor, let's work on it. No, it's continuously working on it. So AI is here to help mitigate these cognitive biases. On the other hand, I think AI still needs the human, and a very easy, pragmatic, practical example I give you, March 2023, Silicon Valley Bank going bankrupt. You run an AI model which has been trained on, say, 10 years of data, historical data. Well, in the last 10 years of historical data, you do not have the occurrence of a large US bank going bankrupt. How can your AI model even can make prediction on what happens next? It has absolutely no idea. It's never seen it before. So this is where, again, the human has to take control and say, okay, I've got the hands on the steering wheel, and I'm telling you, we don't go overweight US financials today because you have no idea what's happening right now. So these are more risk mitigations, if you like. You let the dust settle, and then you can go back to your model. Okay, so these are, I think, for me, 2 examples, but the relationship mind and machine for me is like absolutely fascinating because there are pros and cons on both sides.
Dr. Suraj, I want to ask you the same question. What do you think about with tokenization? How much is there still to sort of human oversight to autonomous?
I'm trying to think how human oversight and tokenization, I think we're kind of talking about 2 different things in that, because in tokenization, it's just working on a digital asset that is used to represent something behind it. It's backed by a treasury bond or backed by something that has value. So I guess I'm not really, I don't know how to answer that question. I'm not sure how there's, it's not really an AI model in that sense that there's something human behind it. It's backed by an asset, and then that asset is now assigned to something that has value, and then the goal is to have an asset that's producing yield, but in a different way than it did before, because now it's assigned to something that traditionally had already made yields, and now you have a digital asset that's working with it.
Yeah, so I guess we can be quite safe in terms of AI not taking over our jobs. Although the statistic says, I think, that by 2030, 65% of all jobs will be augmented, which is interesting. And the last question from me to all panelists before I pass it to the audience, maybe for 1-2 questions, is in your personal experience, what has been the biggest shortcoming or disappointment with AI?
I can start if you want. So let's call them frustrations, right? Frustrations, but you learn through them. I think maybe frustration for me is, I don't know if there's some in the audience, data vendors. Oh my God, you know, they try to tell you, test our data, it's like different from the rest, you know, global coverage going back to the year 2000s and even before. Okay, you say, I'll sign the NDA, I'll put some you know, time and effort into it, and we'll test it. The data arrives, and obviously it's global since 2015. There's no Japanese stocks, and it's not point in time, it's all estimates. So you're wasting a bit of your time. So I find data, it's very hard to find actually new good data sources to feed AI models, I find, because it's hard to find a data model that is very different from what already exists. And then maybe another frustration, as maybe some of you embark into AI for investment management, and a mistake that many of the more junior, I think, guys do is don't go for too much sophistication. There's like this bias variance trade-off. Be completely aware of it, that as you get more complex, like sophisticated / complex model, complex in the sense of many variables to tune. Yes, your model will be able to fit the past better in your training data set, but your variance, as in your error in predictions going live, goes through the roof. So there's a trade-off between obviously not having like linear models with the opposite, a big error in a training, and still errors in real life. You need to find the right trade-off between like sophisticated models, but that don't overfit the past, because you're in for like otherwise a very you know, poor surprises as you go live. So these are, you know, continuous kind of roller coaster moments from the data side as well as the sophistication, if you like, of your algorithms.
I know it's getting harder with each next answer, so.
Well, I face disappointments in every 1 hour from AI. But the real challenge that we face in AI is talent. Talent is very difficult. People are focused on one area of AI. So he'll send you his CV, AI, generative AI, everything is beautiful, he'll answer you. But when he comes, let's say he'll say to you, I only know LangChain. Do you know how to do this? Do you know how to do this? No. So talent is very, very, very scarce, and having them all together. Like I wake up 3 o'clock in the morning, sleep at 6 o'clock, 7 o'clock at night to manage 3 continents. This is the main disappointment or what we face in AI.
So I think from my perspective, the biggest disappointment has been, first of all, the fact that the uptake for the usage of AI has been the fastest with those who are least qualified to be using it. And that results in a lot of, well, we go back to the old adage, right? Garbage in, garbage out. I mean, we have artificial intelligence, it's a tool, but you can't, the results you get from it will be very much dependent on who's using it and how they're going about using it and what kind of information or prompts you're using and so on. So for me, the biggest disappointment is that, yes, the uptake was very fast with all those who were probably either not qualified to use it or using it for the wrong reasons. Like I do training as part of my Black Mountain Consulting corporate training, and I use AI to enhance some of the course content I create or to brainstorm, for example. But I'm qualified enough to differentiate between, firstly, the fact that AI is not always right, so we have to know that. So differentiate between what's coming back to me, whether the accuracy of information, but you see other people utilizing it in such a way just to be lazy, which is not the purpose of it, as far as I'm concerned. So for me, that was always the biggest disappointment so far.
Yeah, I mean, I think echoing the same thing, it's a predictive model of what it has seen in the past. So if the data is not complete in how to, you think AI is going to be something that's going to be able to tell you what happens in the future, but it's hard to predict something that it's never seen. So if you feed it with limited data, you're going to get wrong results or biased results that if people are depending on those results to make decisions, it can result in bad disasters.
Any questions from the audience?
Well, I just want to comment on what Shabnam has mentioned. Probably the artificial intelligence is probably the misuse of the word, right? I mean, it might not be that intelligent. And the fact that it's just like hiring a junior person to do some of your jobs, unless you really can monitor and you're qualified and you're just going to get that quality. But that we can do in some tasks. However, if you're actually looking at big data and you're analyzing a lot of this data, how would you be able to distinguish that level of intelligence? And is it really intelligent enough for you to depend on those outcomes? Whether you have the history or not. I think this is still in development. It's not really as intelligent and as everybody is trying to make it to look like.
So just to comment on that, absolutely, 100%. But I think when it comes to the big data, what we do have, and Xavier, you probably have something to say about this too, but it's, again, having big data and then organizing it and pre-screening it, and you still have to do some work with it prior to being able to utilize it. And then, of course, you normalize data, you standardize it a little bit. There's a lot of tricks and tweaks that you can use to ensure that when you are utilizing that big data, your results are not useless, essentially. But there is a long way to go, that's my belief, because we don't have standardized, obviously, procedures and regulation and so on for this. So there is a gap, but there are things you can do to ensure that at least you're, like, you know, removing duplication and, like you said, like I said, using the normalization of data in general to make sure that you're at least within a sensible range.
Yeah, thanks for the question. And it's a long way to go. I think that's what I was going to start with as well. So if you look back, 20 years ago, the smart beta factors were coming out. You know, people were saying you have to invest into a blend of momentum, value, quality, stocks, etc. And that has changed a lot. Because either these equity risk premia were badly defined, as I mentioned before. You need AI is a nice tool to be a bit more dynamic, and people realize today that, you know, factors don't always work. You need to maybe sometimes get out of this factor religion and be agnostic. So AI, again, is the tool to help. Now, does it always work? No. There are ways to mitigate this. So we put on the side, of course, all the data governance side is given, right? You need to be very clear that it's garbage in, garbage out. You have a team dedicated to the data. Okay, but let's say you have it. Next, you need a diversified source of models. So for us, we use tree-based models, random forests, gradient boosting. You also have neural networks models. And they actually give you quite different outcomes sometimes. They can disagree, and it's good to disagree, actually. Also, you need to look at the fact that it's not all about feeding the models stock-specific data. In order to make the models very smarter, let's say, macro matters. So you need to find ways to also feed the model macro data, so the VIX, the oil price, etc. And the model will actually learn that based on different macro regimes, different features are more or less important. And the model, for example, learns that today, with the VIX at 14, 15, actually you want a little bit of risk off because, you know, markets are stretched, etc. When the VIX is at 30, it's the best time to go actually risk on. So you see, like, if you use the risk feature, then depending on the macro, the model will tell you be like this or be like that, be more risk off or be more risk on. So these are levels of sophistication you need to put into your model, but there's still, of course, no guarantee that's going to work. And again, you have to be humble and sometimes say, as I gave the example of the US US banks almost 2 years ago now, be humble. Your models are not perfect. Sometimes you need to grab the wheel and you drive. But again, so through good data governance, a mix of models, as I mentioned, and good data in a sense, not just stock-specific data, macro data as well. Then, you know, the information coefficients, i.e. the predictive power of your models, improves through time.
And sorry, just one more thing to add to that is the human factor. That's where it becomes extremely important because especially for the new niche industries where you're talking about things like carbon credits or you're talking about, you know, tokenization of private equity funds, for example, or any more complex alternative asset class, what you need there, and ESG, green sustainability, these green bonds, blue bonds, and all of that, you need a subject matter expert because what you're doing now is you're using AR to download data from IoT devices or from satellite imagery and so on. But these are all spaces that we don't really, most of us don't really understand or we don't know enough about, but you do have subject matter experts, and having that human factor when you're doing these analyses is what's critically important then in those particular cases. I'm not talking about listed equities and all of that. I'm talking more about alternative asset classes here. But yeah, that's the other factor. The human factor still has to come in. So as you said, Dennis, we're not out of a job yet.
So maybe there's a case to be made that if you don't have enough data in terms of how many different variables you can use with a long history, at least 5 years, bare minimum, then maybe AI is not the right place to be applied because you need large data sets. The AI is all about finding nonlinear relationship between all these hundreds of variables you're going to feed the model. So if you don't have a long history of point-in-time data, let's forget estimates, right? Let's go for point-in-time data, bare minimum 5 years on the wide universe, then maybe AI is not for you.
And just there's another question. There is the microphone. We can have one more question and then we will finish. Because we are the only thing standing between you and lunch.
Okay, so my name is Carolina Rios and I am associate partner at Calm Legal. So particularly in the crypto space, it's very interesting how AI is coming into being very autonomous. So now you know that we have models that can actually have a wallet, they can develop strategies for trading, and also they can hire people. So what we see in the AI space, we see that these autonomous models, actually, they can generate by themselves. So as the market is moving, it's very unlikely that we are able to follow the complexity in some point. So the idea is that AI are going to actually execute activities and the work that many of us, actually qualified work, are developing currently. So my question goes into, what do you think is going to be the type of work that in 5 years or 10 years would be required to be still human-driven works and not developed by AI?
Let's have 1 or 2 panelists answering that. Xavier, you had something to say? Yeah.
I've spoken a lot already, but so I don't, if you have a...
Well, I don't think so. Within 5-10 years, AI will take a lot of humans. What we see when we develop AI assist humans. So things will be faster. You will be less hectic, I believe, at work, and you will have more time for your freedom. You will have more time to find your passions, all of these things. So in 5-10 years' time, no, maybe in 20, yeah, but 5-10 years' time, we are moving very fast. As we talk, I know when I go out, I will open the newspapers, I will find a new model, a new thing coming up, but it's still not there. Don't forget, when I take the humans, I jump into robotics, which is a different playground than what we do.
So I think on my side, for example, in machine learning that we use, maybe the most recent model I can think of is gradient boosting. That was, I think, unleashed 7-8 years ago now. I still think, the value add is, we use, like, for example, neural networks, if any of you knows, like, we use the Keras architecture, but the value add for us is how you build these custom layers. And for now, I don't think I've seen on ChatGPT the solution into, I got this problem, build me a smart neural network with, choose the loss function, tell me which custom layers we need. I don't think we're there yet. Maybe we'll get there, but yeah, I think in that case, then we'll use our time to think more about how do I add value to my customer. So the technology is here. What does my customer need really? And then how do I apply the technology? I think that's great actually. We'll be able to more focus on value add to the customers. Having this said, many asset owners are already feeling a bit like, it's getting a bit black boxy now. If I were to tell them, don't worry, it's ChatGPT gave me the code, I don't think they're ready for that. So, but again, who knows, in 5-10 years' time, it's hard to predict. But I think for us, this is great because we'll be really able to focus more on what does the actual customer need. And we'll have the tools available.
I'd like to comment on it from a very different perspective from my medical background. I'm actually a radiologist, and that's one of the few fields where AI we're afraid will be taking over, because it is a data-based type of medicine where you're looking at patterns and you're saying that this pattern is abnormal. And even though it's been developed pretty well from over recent past, we still find that it does make errors, and there is still a human involved like there is in finances. But it is getting a lot better. So if it can get better in something that's pattern related in medicine, and it's figuring out those, I don't think it's ever going to get to the point that it can 100% diagnose a disease and take all of the vital signs and say, this person has this. But it can give guidance in that sense, in that it's helping. Right now, when we think of someone has an illness and they have certain signs of what we think is going on, we might go down a list of 5 or 10 differential diagnoses that are the top ones. But then there's like another 10 or 15 that are very, very rare. That's not something that most people will think about. So I think AI in that sense might help bring some of those to light, but I think there's still going to be a human involved, or at least I hope there's a human involved.
So I started my opening remark with the UE, 1971, and since then it's become one of the top hubs in the world for technology. And I guess, you know, the chain of bold decisions, vision, and execution has really impacted like what we see today like outside. So my message to all of you, I think all of us have to do our part. There are the engineers which have to build, there are the students which have to start startups, and to the investors, take risk, be bold, evaluate, but do take risk. And I think the UE is just getting started. Thank you.